Welcome, everybody, to another Savvy Investor training session today. I want to welcome all of you guys to our YouTube channel. For those that don't know who I am, I'm Mike Ponte. I'm the founder of Savvy Investor and longtime Canadian real estate investor. And I am looking so forward to sharing on an extremely popular topic as of late. And that is the topic of multifamily investing. I'm not sure if anybody else is interested, but raise your hand if this is a topic that has been of interest to you, maybe something that you've been interested in investing in. And it has been very, very popular strategy. And I'll explain why very shortly. I promise you that. But for many investors right now, multifamily can seem like a little bit of a pie in the sky objective. It feels like it's such a big jump from that residential investing strategy. And for a lot of people, that may be feeling like you. If that is you, chime in on the comments. Let's hear if that's you. And I totally understand because I was there too. Many years ago, I felt like that. I'm like, getting into multifamily, oh my God, this is a kind of a scary experience, right? So, but it really is an excellent investment strategy. And this is the best part about it and why I enjoy it so much. It really is all about the numbers. And once you understand that, it really makes you more comfortable about investing in this strategy, which is why I thought I'd bring this topic as our today's Savvy Investor training session on our YouTube Live. Again, it's all about understanding how best to evaluate and analyze multifamily properties. Now, for those of you that don't like numbers, you're probably not going to like so much about this presentation because this is going to be a lot of numbers today. Not too much, a little bit. But for us that love analysis, and if that's you, raise your hand because I'd love to hear it. But for me, I love the numbers. And in this game, this is all about the numbers. So very, very excited to kind of be sharing on this topic today. But before we kind of get started, just a few housekeeping items to review. Don't worry, I'm not going to ask you to turn off your cell phones, especially for those that are actually watching this on their cell phones. But again, this is a YouTube Live. I want to make sure that I can get your questions answered and your comments responded to. So please engage. I love to make our sessions very, very engaging. And again, the more you share, you're also helping your fellow colleagues as well. And to help you kind of keyboard warriors get engaged a little bit as part of the sharing of comments, if you haven't had an opportunity to as of yet, please take a moment to subscribe to our channel and also like this video and also hit that notification bell. This will really help support us in the growth of our channel as well. We'd really, really appreciate that. And more importantly, we're going to keep you guys informed of upcoming videos that we've got lined up. And we got some real good ones coming up as well. Very, very excited. So with that being said, let's kind of get to the topic at hand. And I'm just going to roll up our presentation here. Let's make this a little bit bigger. And let's just maybe make a couple small changes here for this to make it a little bit more appealing. There we go. That's a little bit better. Okay, perfect. So let's kind of get to the topic. And I thought maybe the first thing that I would begin with is let's kind of get a sense or a lay of the land. What's going on out in this crazy, crazy market? And it's really more, and it really does lay the foundations of today's presentation. And so with that being said, I'm not sure if anybody else is noticing this or it's just me, but things are pretty interesting out there. I don't know if anybody else notices, but it is very, very weird and very strange. And just as soon as you thought all these challenges from COVID have kind of come behind us and we've kind of moved on from this whole thing, like a punch in the face, we have to kind of deal with the situation of inflation. And that's always kind of a big problem that we're facing right now. We're seeing things, if you guys haven't been watching the news too often, you're probably seeing a little bit of this, is that, hey, inflation rates have kind of come down a little bit. So it's taking a little bit of pressure off. But as you can see, we're still at some pretty significant heights. And this is becoming a real big challenge. And a lot of this really is based on some of the previous stimulation that we've had to get covered off. Is now coming to roost. You know, we've been getting paid by the governments. All of our money was in our pockets. We're kind of in a spending frenzy at an all-time high, and it was increasing demand of all things. So all these things that are happening right now in regards to price increases for groceries and houses and cars and everything's going up. And for those, especially when it comes to the grocery side, I don't know if any of you have got kids. I've got 2 young adults at home. I am definitely feeling that when it comes to the grocery side of the business. And so this is one of the things that the government is trying to obviously do purposely. They're trying to kind of temper some of this stuff down, right? And this is one of the tools in their tool chest to kind of help offset that. And that's obviously, whoops, let's go back to interest rates. And so we've all seen interest rates going up. I'm not sure, again, if I'm the only one, but I am definitely seeing interest rates going up. And just to kind of go back, as I was kind of preparing for this presentation, it was kind of interesting. We've had 8 rate increases in the last year, starting March 2nd, 2022, a full year as of tomorrow. Isn't that interesting? And we've had a total change over in our interest rates of an increase of up to 4.25% increase above what we once were a year ago. So that has been interesting. So we've not seen these level of increases and escalation since kind of the 90s. And for those that may have been around at that point, it's kind of a scary time. But to add insult to injury, and what's happening today is that a lot of people with all this inflationary pressure that's occurred right now, it started off with people being in the wrong foot to begin with. And, people are like significantly over leveraged, using their HELOCs as piggy banks for the wrong things. And now that's starting to kind of create a little bit of a challenge of what's going on in the marketplace. And so that's kind of what we're seeing. And probably for a lot of people, they may resonate a little bit of this, is the pockets are getting kind of a little bit drained. And so that's one of the biggest challenges that we're facing, is there's this lack of disposable income in our pockets, as most of our money is actually going to supporting debts. So this is, these are some of the little extras that we once been able to spend on are starting to kind of go out the window. And that's, again, why the government has done what they've done, is to start to kind of temper some of these things down. They're wanting to kind of control some of this stuff to take some of the pressure off. So with that being said, that is what's kind of occurring. That's what's going on right now. And obviously with the Bank of Canada increasing those interest rates, one of the biggest issues that we're tending to find is the spending of housing is actually going down as well. So with that, during COVID, prices were soaring. They're going significantly over asking price, multiple offers. Everybody probably remember those good old days, just like, why am I spending so much money on these properties? Because if you don't, you're not going to get it. But, the good old days are kind of gone. So we used to spend all this money. And then what's happened now is affordability has really severely been impacted in a lot of markets. So with all these prices that have gone up drastically, it impacted affordability. And now we're kind of seeing everything kind of turn completely opposite. Okay. So for many markets, as we're seeing, prices are already starting to go down because we're just not seeing the same type of demand for single family properties as we once were, because people just can't afford it anymore. It's becoming too expensive, especially the way interest rates have gone up. And again, some of the interesting things that are happening, why the Bank of Canada is doing what it's doing. And again, things will be very, very interesting, especially for this coming year, and especially in the next few months as we roll into real estate spring. Okay. So just for those that may or may not know, real estate spring, this is the busiest time for real estate normally. So it'll be very, very interesting to see. Now, with that being said, I thought it'd be good for everybody to have a little snapshot of kind of a forecast of what's going on. And I'm just going to expand on this so everybody can see this a little bit better. But truly, it's interesting. It is very, very interesting. And so here are some of the forecasts and some of the predictions that they have from market to market, province to province. I hope you guys can see the numbers. It might be a little bit small, but hopefully you guys can zoom in if you're using your cameras or whatever the case may be. But again, it's very interesting, especially when you're looking at market to market. Okay. So there are some markets that have more reasonable affordability that is not as impacted as others. And then some of the ones that have had affordability challenges, this is where the biggest issues are. So if you tend to see the markets like in Vancouver and Toronto, we're seeing the biggest amount of growth over the last few years. Those are the ones that are sticking out a little bit in regards to some of the challenges. Okay. And so just be aware of this. The worst is kind of not yet to come, and there's still some more challenges in the single family marketplace in specific markets. When you look at this, it's actually quite interesting too. When you're seeing markets like Alberta, where it's been very, very affordable, there's actually not a lot of impact, which is quite interesting. So again, when you're looking right now, look at places of affordability, because this is what's really going to stick out. And where places are not affordable, is where you're kind of seeing opportunities, especially based on our discussion today. So with all this discussion of doom and gloom and sadness and all this stuff, why in God's name would anybody be looking in the real estate market, especially for us investors? We're just like, oh, you guys are absolutely crazy to be jumping into this thing. Why are you going to be buying real estate right now? Have you seen what's going on with real estate prices? I don't know if anybody else has had that discussion. I've had it, but again, I've been through this before, so it's not my first rodeo. Okay. So, at the end of the day, if you see what was going on and you didn't really like that type of slide, it's kind of interesting. It's like you pay attention to this, and it's like not every market is not actually being impacted. And that's actually true also in the investment strategy as well. So when you are looking at what's going on today, just because it's happening in a specific segment, it doesn't mean it's impacting all real estate investing strategies. And that's one of the reasons why I think a lot of people are here today. So what's going on? Again, there's not as much demand for the residential space. We're seeing things starting to kind of erode. People are not able to buy anymore. And here's some of the other things that are creating some impact as well. If people are not necessarily buying properties anymore or single family homes, they may be renters longer. The renters that are in the market today, they may be wanting to invest in a multi-family or a purchase of a home. They may be holding out just because interest rates are too high. It's becoming impactful. So they tend to be renters a little bit longer. The same thing also happens with our younger generation. They're now wanting to not necessarily buy a home right away. They are renters first. So all of a sudden, we're kind of in a position where the demand for rental properties is going up because there's not as much inventory as you would tend to see as in the past. So there's not much inventory in the market. Okay, so this is the reason why I think a lot of people are wanting to chime in and learn about this, is because multifamily is valuated, or the way the value of the property is very different than single family. So when people aren't buying single family, again, they're staying renters longer. So if they're staying as renters longer, there's a lot more demand going into rental units, and there's just not as much inventory. I'll challenge you guys. Guess what happens to rents? Who wants to take a guess what happens to rents when there's not a lot of inventory in the market, but there's a huge demand for inventory for rental units? I'll let you see. Chime it in the comments. Let's see if you know the answer. And if you haven't figured it out, yes, guess what? It is rents start to increase. And if rents start to increase, this is actually a very good thing in the multifamily space. And for that, let's take a quick look and see what some of the numbers are. So with that, let's pay attention. This is actually coming from urbanization. It's an article there from rentals.ca. And this is kind of some of the trends that we're seeing in the rental markets. So if you said rents are going to be increasing, congratulations, you're going to win a prize. I have no idea what it is yet, but I do know, but you will figure something out for you guys. So with that being said, take a real good look at what's going on with the numbers, because it does justify some of the things that I've communicated with you. And even though we're seeing cap rates in specific markets as well, if you're seeing any turnover in some of these properties, rents are going up. And so when we take a look at the section where it references totals, that's what we're seeing, kind of a year-over-year change in all segments. And so when you're looking at Alberta, 14.6%, BC, 14.4%, Nova Scotia, 12.2%, you're seeing all these, the demand is actually occurring. And this is kind of what we see as an opportunity, because this is very good for multifamily investing. We love this kind of stuff because a lot of landlords right now have got big smiles on their faces, because they are seeing increases of their value of their home or their buildings come to fruition. Okay, this is one of the things that's quite interesting. Okay, so with that being said, we're seeing this influx of demand. Again, we're seeing demand that renters are actually staying renters longer. We're seeing a younger population that's actually wanting to become renters. They're getting out of the house. My kids aren't leaving the house at all, but at some point in time they'll leave, but they will be renters at some point in time. So when they become renters, they're going to be battling it out there against other renters as well. But there's something that's been very, very interesting as of late. Another strategy that's really been picking up, and I'm sure many of you guys are seeing it and you may be involved with it today as well, that's also impacting demand. And the biggest thing that we're finding is also short-term rentals. Short-term rentals is actually adding even more pressure to the rental market as well. So for a lot of investors, and rightfully so, and understandably so, is this strategy with short-term or mid-term rentals, excellent strategy, can work very well. And that's a whole different topic for a different day. And we've done a YouTube video on this. And we had a great session with Mark Hernandez. If you guys want to check it out, great strategy, great individual. But people are using short-term rentals and mid-term rentals to help offset the impact of increasing of these rate increases to maintain the cash flow that this property was once producing. And so it can be a great cash flow generator for sure. And so they're going to this strategy because, again, if you have government policies controlling in regards to what you're able to raise your rents, and then with that being said, this is yet another strategy you can implement into your existing residential portfolio to try to maintain and boost some of the cash flow. This is a real good strategy, but what this is also doing is the demand for this type of segment or this strategy has been significant. And with that, we're seeing this also reducing some of the inventory on the long-term rentals that are also available, adding more pressure to inventory to an already a very small segment. And so with that being said, that's why you're seeing a lot of government controls trying to manage this stuff, especially with short-term rentals. And so with that being said, they're trying to obviously maintain the long-term rental market. So it's kind of like a little bit of a double whammy that's kind of going on. There's less inventory in the market. There's higher demand, which means higher rents. In multifamily, this is increasing something that we call, and you guys might want to write this down, net income or net operating income, which is actually the way we increase the value of our apartment buildings. Don't worry if you don't know what that is. We're going to go through that today. So in a lot of ways, this is all putting smiles on our faces for those that are owning or acquiring properties, for those that are looking to get into the multifamily space. And we're seeing this demand for multifamily. This is a good thing. Like, this is great. We're loving to see all this kind of stuff growing. We love to see rents going up 14% because it's increasing our value. So with all this concern that's happening in single family, we're impacting a single family, we may not seeing the same impact when it comes to multifamily. Okay, so we're hearing all the news. Sounds pretty crazy, sounds scary, but this is good opportunity for sure. Okay, so have I piqued anybody's interest yet? I'm not sure if I have, but hopefully I have, because if you are, you're in the right spot. So good. So how do we begin our journey in multifamily? And that's the topic at hand. Now that we've kind of got through some of the economics, hopefully that was a kind of good broad brush stroke of what the temperature is in the real estate market. How do we get started in this multifamily journey? And more importantly, what are we looking for? Hey, anybody else want to know, or is it just me? Okay, let's keep going. So the first step that us real estate investors, especially for those that are just getting started, is the importance of understanding your market. That is number one. And when I say that, it really means getting a sense of where in the market you are going to be investing in. Where are you interested in? Okay, this could even be within your own hometown. So when I say this, what I'm asking you guys to do as investors and to become more sophisticated in this is understand specific areas within your market of where you are interested in investing in. And as I say that, and to explain it, there are good areas and there are, what's the right word for it? Sketchy areas, if you know what I mean. I'm sure that just by me saying sketchy areas, you already kind of know what I'm talking about, right? So know what location you are looking for. Try to understand the area first and foremost. So what part of this town, is this a good area to be in? Is this a good area or a bad area? Is this a good area or a bad area? So you're trying to identify these locations first and foremost. especially when you're investing in a market that you're not used to. It should be one of the first things that you do is assess the area and assess the area. So how do we do this? And especially in multifamily, this is a very common dialogue. It does happen in the single family side, but it is understanding your neighborhood classes. In the comments, have you guys ever heard of neighborhood classes? And that really means a class A to D area, class A to D. If anybody's ever heard of that, just raise your hand if you've heard of something like that. Okay, so there is a class A, class B, class Z, and class D. So we're going to just kind of briefly touch about this, but again, this is what you're trying to understand first. Make sure you know the areas you're focusing on. Okay, so class A. This would be kind of your best locations. You know, this higher class, think a newest area, shiny with all the most current amenities where there's like a new pool or new buildings being built up, new grocery stores, all this stuff. Think about more upper class. Okay. So getting some of the best tenant profiles that are out there. Usually in a class area, this is going to be your more higher end, higher price point areas, if you know what I'm saying. If you know what I'm saying, identify, just throw it on the chat, let people know where you are, and identify what a class A area is in your market so we can all kind of learn about your specific market and an area that is a class A. Okay. Now, the next one is class B. Class B market is usually a little bit of an older area just outside of class A. You know, properties aren't nice and shiny. They may at some point in time been class A back in the days, but definitely in a more established neighborhood. Okay, they've definitely been more established neighborhood. Still attracts good quality tenants. You can definitely get some better price points than you would in a class A. You're still attracting good tenants, still good property, still good area. So you might be in an area where it's just like, hey, this is still a very good, solid area. It's not a class A area, but it's just underneath it, and it's more of a comfort zone. For a lot of investors, they're kind of focusing in that B area because of price points, still attracts good tenants, and at the same time, there's still good valuations that come in there. Well, now we kind of get to the bottom part of this, and the bottom part is, you know, your class C area. And again, this is kind of outside the class B area buildings, a little bit more tired buildings. With old tired buildings or tired area also comes tired tenants, if you know what I'm saying. Okay, the tenant profiles maybe not the best, if you know what I'm saying, but you can get some decent pricing when it comes to this. There's definitely more maintenance that comes along with the building, probably higher turnover. But with that being said, it can actually be a great opportunity for investing, but you just got to know what you're getting yourself into as you're jumping in. So class C area is a little bit more of a rougher area, if you know what I'm saying. And so that's what you're wanting to identify. Class A, B, and C. So making sure that you know exactly where those are. And the one you absolutely need to know, and especially for those of you that are investing in a different market, different country, I don't care where it is, you absolutely need to know where the class D area is. Okay. Now, when I say class D, I want you to kind of create a mental picture in your mind and think about your neighborhood. I'm sure you guys are all thinking about a street location and you have an idea where it is. And as I asked you guys to do in class A, that's great. Do the same thing in class D. What class D areas do you know in your market that you can share with your other savvy investors to kind of give them a heads up in advance? Okay. But class D areas, let's just say it is not a really great place to be. Okay. For those that are locals like myself in Vancouver, near Vancouver, that location is Main and Hastings. The reason why I say that is because a lot of people in Canada know what Main and Hastings is. It's in the east side. You know exactly what type of tenant profile you're attracting. That is just what it is. So just understand that is a class D area and making sure that you understand where that is. And more importantly, you also need to understand what you're getting yourself into, especially for those that are investing in different markets. Know these different areas. The point is that you need to know these areas before you start investing, because if in a lot of cases, this is a big mistake I see with a lot of investors, they invest based on price and they haven't taken the time to really understand the area. Okay. You can always change the building. Okay. Always change the building. It's really easy to do. You can renovate it. You can make it look beautiful and make it look great, but you can never change the area. You personally can't change the area. Mike Ponte can't change. If I build a property on Main and Hastings, I can't change that location by me doing that. Okay. The tenant profile in the area is what it is. So you need to understand that. So again, know the area. So the important part, focus, understand what area you want to focus. Is it a class A, B, C, or D area? Identify what that area is. This is part of the evaluation process and should be one of the first things you do. So you determine that I am looking in section A. This is the community. This is the community. This is the community. And then with that being said, it's also helping your investing team as well, because they know exactly what you're looking for. Okay. I hope that makes sense. So that's the first step, is part of the evaluation process, is evaluating the area and making sure you know where you're actually going to be investing in and focusing your time and energy first and foremost. Okay. So with that being said, we've determined the area, we've kind of picked it out, and we're just said, Main and Hastings, that may not be the location for me. Maybe Kitsilano in Vancouver is a better spot. Now you've kind of identified that as probably more of a B plus location for you to kind of be investing in. Okay. So once we've kind of determined that, the next piece that you want to ask yourself as part of your evaluation is understanding the market cap rates. Okay. So within that area that you are looking at, you need to understand what the market cap rates. Now, for some of you, you've heard of cap rates before. And for some of you, you may know what it is, but you actually don't really know what it is. So it's okay. That's why we're going to talk about it today. So if you don't know what a cap rate is, raise your hand. It's okay. I want to see your comments, because at the end of it, I want to make sure we get those questions answered for you as we kind of go through the presentation, if you don't know what that is. Okay. But this is a really important one, because cap rates is really how you determine the market area. And so let me kind of explain that in some more detail. So when it comes to the residential market, we tend to use comparables. Okay. So if this is kind of an image that you take a look at and see, and you just see this, this area, we look at kind of common properties, very similar properties within the area, to determine kind of what the price is of our home that we are about to buy, right? That's very, very, very common. Okay. So we're looking at multiple different properties. We're seeing them all and it's looking great. And then we compare this to our property and we have to kind of say, okay, the value is probably close to this. Now, in the multifamily space, it does look a little like this, but the biggest difference is you're not seeing numbers like what we're seeing in the image right now. What we are seeing is actually percentages. And this is something that we call cap rates. Okay. And the cap rate is a determination of how the building is performing. So one of the things we're going to talk about very shortly here is when you are looking at a multifamily property, you are not buying a property per se. Okay. You're not buying a property. You are actually buying more like a business. Okay. You are buying a business. So a multifamily property has more commonalities to like a coffee shop or a dentist practice, or I'm just trying to think of another business. I'm trying to think a restaurant, than it does a single family home. Okay. Even though the customers are the same, being tenants, at the end of the day, the way a business is being evaluated is actually based on income. And that's what we're going to spend some time talking about. And multifamily is very similar in that fashion. So you want to do some comparables of other multifamily buildings to see if this business, the business that you are buying, is comparable to others. And that's how we're doing something called the cap rate. Okay. So with that being said, what in the heck is a cap rate? And I don't really understand that. And for those of you, it's okay if you don't, because we're going to go over that right now. So let's go through the details of cap rate. Okay. So you guys can take notes, fill your boots, please, to help you guys out. But what a cap rate is, it's the annual net income, okay? So it's the annual net income divided by the purchase price. So how do I calculate the annual net income? And that's kind of the little bullet point right below. It's the gross income. Okay, so that's all the rents, any other income that's coming in, minus all the expenses. So all the rent minus all the expenses, not including your mortgage payment. So all the income minus your expenses, not including your mortgage payment, calculates your net income. You get your net income and you divide that by the purchase price, and that calculates your cap rate. Okay. Now, with that being said, great. You've learned how to identify cap rate. Good for you. That's all wonderful. But again, what the heck does that mean? So the higher the net operating income, then usually the higher the cap rate tends to occur based on the purchase price. Okay, so what you're trying to determine is, does this property produce, or this property cash flow, does this match what the market is? So let's say I am buying a property. Let's say I've determined that the market is a 5% cap. Okay, perfect. Now I am looking at a building that I'm wanting to buy, and it's producing, and it is currently at a 6% cap. Well, that means you are buying with equity in the property because your property is performing better than what the market is. So that spread is actually profit from you. Okay, so that's what you're trying to determine. Same thing holds true more often than not, is that you market maybe 5% cap, but then when you're analyzing this property, it's at a 4. That means you are maybe paying a little bit more for the property than what the market is. So that's kind of how you're looking at it, okay? And just to kind of give you guys a heads up, if you're seeing cap rates at around 4.5%, more often than not, that's kind of a break-even position normally. But the way interest rates are the way they are today, it's not necessarily the case. But we're hoping that at some point in time, rates tend to go down a little bit, and that might correct itself. So with that being said, this is what cap rate is you're trying to determine what the market cap is and how this property performs with the market. It is a comparable like residential, and that's how you're kind of matching this up. So let's have a little bit of fun with this. I hope you guys are okay with this, but let's let me just go through this slide. I forgot about this one. So cap rate is annual net income divided by your purchase price. Okay, so that's what it is. That's cap rate. Calculating your net income is your total rent minus expenses, not including your mortgage payment. Okay, so put it in the chat. Does your net operating income include your mortgage payment? Yes or no? So put that in the chat, so I'm making sure that you guys are learning. Okay, with that being said, what you're trying to determine is you're looking for an opportunity to increase that net operating income, which also increases the value of your property. So as we talked about before, how do we increase our cap rate? Okay, how do we increase our cap rate? So some of the things that we can do, and what I talked about at the very beginning, increase our income. How do we increase our income? By raising rents. What a concept that is, because rents are actually going up. That's a good thing. Okay, rents are going up. That's how we're raising it. The other thing that you can do is reduce your expenses. Income minus expenses equals net operating income. If I can increase income, reduce expenses, it increases my net operating income. Fantastic. That's what I am looking for. Okay, so this is a key measurement that is used for sellers, buyers, bankers. This is what is normally discussed and used. So for you guys, this is something that's really important, especially when you're looking to get into the multifamily spaces. Understanding the valuation, understanding the cap rates to kind of help support you and understand what's going on. So you can all talk the same lingo. We're all talking the same language, okay? So what you are looking for in a property, and again, this is good for you guys to take notes, is as we are analyzing and evaluating, you are looking for opportunities to increase the cap rate above the market. So how can I do this? Are rents too low? Can I maybe reduce some expenses? This is how you increase valuation, okay? And the opportunity is you can look at maybe getting potential very quick equity in a property by doing some very small things. And here's the best part. It's not so determined on what's going on the real estate market. So in challenging times like we're seeing right now, It's actually opportunity. And so it really, when you're looking at it, it's like a business. Is this business performing? Yes or no? If it's not performing well, maybe you can get it for a really good deal and correct it and increase the valuation. We're going to talk more about that shortly here, okay? But this is what you're trying to understand. I'm trying to make sure I leave with you guys is when you're going through this assessment, understand your market, pay close attention to your market cap rate in that area. So when you're going out shopping, you know what you're comparing to, no different than what you're doing in single family, but it's just the value, the way it's being measured is very, very different, okay? So with that being said, let's kind of go through an example so everybody can kind of get a better sense of this. And I hope this works for everybody, okay? So let's pretend that we're buying a 9-unit apartment building. It's $100,000 or $1 million. Fantastic, okay? We're going to get a down payment on this thing plus some reserve funds and all that stuff like that of roughly $300,000. Great, awesome. Okay, now the net operating income is $50,000. Okay, so the cap rate for this building is $50,000 divided by the purchase price. Net income divided by purchase price. Have some fun. Pull out your calculators, follow along, and you can learn at the same time. Okay, so this is what it is. $1 million, that's the purchase price. 9-unit building, down payment is $300,000, and the net income is 50. Cap rate is 5%. That's what we know about this building. So with that being said, let's just say there is an opportunity in this building. We see that, hey, I can raise the rents. I hope everybody can see this. If not, I'll just expand that a little bit better. So we can raise the rents by $75 per month per unit. Okay, so now the net income on this building is $58,100. Let's see if everybody's been paying attention. Let's calculate the cap rate, the net income, based on the new purchase price. Put it in the chat. What is the new cap rate? Again, we've raised the rent by $75 times 9. So now the new income that's been generated for this property is $58,100. What is the new cap rate? I can't see it on the chat, so hopefully everybody's getting involved. Get involved. This is how we learn, okay? So if you've said this, okay, 5.8%, congratulations, you're passing, okay? I see 5.81%. Good job, Brad. Well done. Good on you, Griffin Wood. That's fantastic. 5.81, we'll take it. I'll happy to take that extra little 0.1 for sure, okay? So 5.8%. Now let's pretend that the market cap is 5%. So now the building's at 5.8, the market is 5%. Fantastic. Now by doing this reverse calculation, the new value of this building, just by raising the rents by $75 per suite, which believe it or not is not that difficult, I've just increased the value to $1.162 million. So I've just created equity of $162,000 by raising the rents. Okay. So who likes that? I'm not sure if anybody likes that. I love it. To me, this is one of the most powerful things I love about multifamily. And trust me, this works great. This is another thing you guys can write down and have some fun and put this in your notes. But for every dollar that you raise your net operating income in your multifamily property, you're increasing the value of your building, ready? By 15 to 20 bucks. So the focus is increasing. I hope you guys can see my little mouse, hopefully here. I'm just gonna take a look and hopefully it does work up. But hopefully you guys can see that. For every dollar I increase my net operating income, I'm increasing the value by $15 to $20, okay? That's why we're putting a lot of focus on this. This is what we're doing. So who likes this? Who likes making this kind of money? I know I do. For me, this is great. So as we are seeing all these rents increasing right now, and as I said earlier, us apartment building owners currently are smiling very, very widely right now because this is all really good news, but this is where the opportunities really become available, okay? And again, this is why we're seeing the demand for this segment to be such a popular one at this moment, okay? So that's kind of some of the pieces that you need to understand is we take the time to assess the area. And now we're starting to kind of assess what the market cap rate is. And that's great. That's all wonderful stuff. And now when it comes to this, you've learned this, you've taken the time to kind of look at what the average cap rates, how is this property performing? But as I said earlier, This is a different type of investment than your single family home. As I said before, you are buying a business. And with that, you also need to understand what is your business strategy, okay? Which is another comment that I have to give you guys, because this is part of your evaluation process before you jump in, okay? You know, at the end of the day, I'm sure I've piqued everybody's interest, like, oh my God, I just have to raise the rents and then just do this. Yeah, that kind of is, but there's actually much more to it. You have to treat it that way. This business needs to continue to perform and continue to grow. And just like any business, the real question is, how am I going to continue to grow this business? What's the plan? What's the strategy? So as you're looking at a property, that has to be one of the next questions you ask yourself is, I see this property, I see the numbers. What's the plan? What am I going to do with this? Okay. So part of the strategy that many multifamily investors, myself included, do is we take a moment to really assess. We take a look at, is rents too low? Is expenses too high? What can I do? What can I do to this property that can maybe increase the valuation of this? What am I looking to do? Am I looking to flip this property after I've increased it? Am I looking to do this as a longer term buy and hold? What's the plan? Okay. So when I reference this in the slide here, you can see this, you know, am I looking at a longer time frame for this and a more of a BRRRR strategy? The more if you renovate your units, and again, this is very, very different. It's not like you need to put granite countertops, stainless steel appliances in the unit to make it look beautiful to increase valuation. You need to make it look good enough to increase the rents. And this is a very simple strategy. Sometimes some simple renovations can increase the rents, which increases the valuation. You can do it suite by suite. You don't need to renovate the entire building all at a time. And that's one of the beautiful things about multifamily as well. You can still be making money and renovating suites one at a time. And at that, you're also increasing the valuation over time as well. Okay, simple renovations, vinyl plank flooring, some fresh coat of paint. You can even paint cabinets if you want to. It's amazing what you can kind of do to increase value. Small little things can go a long way. Okay. Other things that you want to be paying attention to is, like I said, you're looking at a property. What's the opportunity? What's the plan? I can raise the rents because rents are too low. Look, there's a shed outside. Maybe I can rent that shed for like $100 a month. For every dollar I increase net operating income, I increase the value of my building by how much? Put it in the chat. Let me see if you guys are listening or paying attention. Okay. Maybe some other things that you can look at is maybe looking at ways to reduce some of your expenses. What are some of those things that I can do? It is all about the NOI. Great comments, Alex. Charge for parking. I first of all read that as charge for the toilet. Probably not. If you can get away with it, fantastic, but I don't think you can. So with that being said, good stuff, guys. Keep chiming in, keep supporting everybody as you're referencing that in the comments. I can see you guys. So in addition to that, is this maybe just a long-term buy and hold, just steady income, great cash flowing? Maybe as much as I want to maybe increase valuation, this is a good solid building that is really going to support me for the long term. Fantastic. What's the plan? What's the strategy? This is a business. Treat it as that. And this is why it's so very, very different. Okay. So again, before you start to be acquiring any building, look at the property. This is my new business that I am buying. How am I going to grow this business? What am I going to do? What can I do to grow this business? Okay. Now, the other part that I want to be very clear, as we deal with multifamily, we also deal with bigger dollars, lots of money. Okay. And it's not to scare you. Okay. It's just, this is actually a good thing. There should be absolutely no emotions to this strategy at all. Okay. You should not be investing based on this. Use it based on this, because it is all about the numbers, which is why I love this strategy so much, because it takes all the emotion out of it. You just have to crunch some numbers. The numbers spit out a specific calculation, and then you can make some determining factor of what you need to do. Okay. This is a really great strategy. It is always about the numbers, and it provides you with a clear aspect of what you need to do with this. Okay. So with that being said, we've determined our strategy. We have done assessment in the marketplace. We have also kind of quickly calculated what the market cap rates. We have a better understanding of that. But the real question is, how the heck do I analyze these numbers? What are those things that, how do we do this, right? So how do we analyze this stuff? So how do we determine if this property can achieve the plan that I have in place? And this is where we start to get into the crunching of some of the numbers, okay? So again, we found a property. Let's pretend we've done it. So how best do we analyze this to make sure this works? So hoping that this is going to work. I am going to try to do something here. Again, technology sometimes works, sometimes it doesn't, but I'm going to give this a shot because, like I said, I've been playing with this, and hopefully it's going to work. Then I can provide you with this template. Let me know if everybody can see this so I can kind of see everybody. And we'll just scroll down to the very bottom here. Perfect. Good. I think everybody can kind of see this. So this is a property analyzer that everybody can kind of see. I'm going to try to do this as well, so bear with me just to make it a little bit more visible for everybody. And hopefully that works out a little bit better for everybody. I think it does. Okay, good. I think I can see it. So this is our, just for those that are interested, this is actually a resource tool that is available on the Savvy Investor website. Go ahead and I'll actually put a link on the description if anybody wants to get a copy of it. It is there. So I'm going to provide you guys with kind of a few scenarios. If you guys want to zoom in a little bit tighter, then so be it. You can go ahead and do so accordingly. I'm going to try to do this a little bit better too. So let's just say this is an 18-unit apartment building that we are looking at. Okay. So we have an 18-unit apartment building, and this is on the one side here. We have got the current rent kind of ranging from 2 bedrooms. We got a bunch of 2 bedrooms, and then we've also got some single bedrooms. We got 5 single bedrooms, and the balance is actually 2 bedrooms, and they're renting for about $1,075. But there's an opportunity to raise the rent by about $25 per suite. Fantastic. Great. Awesome. Okay, great. So as we look at this, we're looking at the rental income. Okay, we started off with monthly rental income of $19,000. I'm able to generate to $19,545. Great. And I'm increasing my increasing my income from $229 to $234. Great, great, great. Okay, so far I'm looking okay. I'm happy with what I'm kind of looking at based on the rent. Now, if I go through some of the expenses, I got these expenses here. And again, I'm just going to keep it relatively simple. So you're going to see the heating cost, taxes, insurance, property management fee. I put it at 6%, vacancy allowance, resident manager allowance, repair and maintenance allowance, all that fun stuff. Okay. Now I've kept these numbers relatively simple, I hope, for you guys just to watch and see. And that's really the intent. So don't kind of criticize me about, hey, Mike, I think your property management fee is too high or too low. I know for me, I pay like between 4 to 5%, just so you guys are well aware. But at the end of it, I just put those numbers in just to kind of present it. So we've got our gross income, which was here $19,095, subtracted by our operating expenses, which is $11,808. My monthly net operating income is $7,290.70. So that's my annual net operating income of $87,488. Fantastic. Okay. So this building's up for sale at 1.275 million. Okay. Perfect. Okay. I just put the interest rate at 4%. Again, we can play with the numbers to our heart's content. We're going to say we're going to put 25% down, amortize it over 30 years, and plugging this information in, off we go. Now, one of the things that we are seeing, and I hope you guys can see this, is on this one section, it is row number 118. You'll see we've determined that the market cap rate is 5.25%. So we've determined that that's the average market cap. So based on this purchase price and the income and the information that's available, if I look in my analyzer here, it's showing that the cap rate based on the property is 5.07%. So that means I am paying probably a little bit more than what the purchase price is. And it's actually done the calculation for me. And it's actually, if I went to purchase this property at market cap, I should be buying it at $1.666 million. I don't know how that number just popped up, but it did. So right off the bat, I am probably paying a little bit, maybe roughly between $40,000, $60,000, $70,000. And that's what it is if I went to pay full purchase price. One way to offset that is like, if I want to, here's my opportunity to negotiate and say, hey, Mr. Seller, the cap rate is this. I want to be able to drop the price. Okay, that's one option. Now, as I referenced before, I have the ability to raise the rent because the rents are a little bit lower. And I've actually put this into the numbers above, if everybody remembers. So I've increased all the rents as my projected rent here. So here's my opportunity. I'm going to raise the rents a little bit, and that's fantastic. And with that being said, I am going to scroll back down, and you will see that the projected income, if I raise the rents, now the property's cap rate is currently at 5.31%. Okay, so now I'm actually slightly above the market. So by raising the rents, up to that point of 25, I'm a little bit above market cap. Okay, so for me, that's great. Okay, so this could be a property that might be of interest where it would be more of a longer term buy and hold. You're comfortable with the cash flow, you're happy with it. And now you're like, okay, you know what? I'm okay with the way this number is going to look. And I'm just going to do this as a long-term hold. So this is one way to assess a multifamily property. You take the numbers, plug them in, and see what happens and see what it produces. Okay. Now, with that being said, another option is, let's take a look at it from a different perspective. Okay. So this is just kind of your buy and hold strategy. That's just typical standard thing. Now let's take a look at an opportunity if there was some serious equity. Same example. Okay. Rents are $1,075, but now we're raising the rents to $1,150. So we're actually raising the rents by an extra $75 for the 2-bedroom and an extra $50 for a single bedroom. Okay, perfect. That's great. With that being said, we're going to scroll this down. I might just try to do this a little bit to see if this makes it a little bit easier for everybody to see, because I think the numbers are a little bit small. Hopefully that helps a little bit. Okay, so with that, you can see that the rents have all been increased a little bit. And so now we're going from a $19,000 monthly rent to a potential forecasted $20,320 a month rent as well. Okay, so as we kind of scroll down, there's your annual rent. Here's your expenses. Let's get down to the fun stuff. Here's our net operating income. We started at $87,000, and now we've actually bumped it up to $112,000 per month. Fantastic. So let's take a look. Now at the purchase price of $1.725 million, we are determined that the market cap is 5.25%. But by that further increase, we've actually been able to increase the cap rate, which has also increased the valuation as well to $2.134 million. So with that being said, this is where there's opportunity. This is a good opportunity for this particular property. So just by doing some small things, we've increased the value of this building. Okay, so do I like this? I like this. This is good. This means equity in my pocket. This is what I want, to find deals like this all day long, and I'm happy to look at these types of projects. Okay, another one that we tend to see very commonly, very commonly, is we tend to look at a property that may be having the same type of rent, $1,075, $950, and again, we brought the rents up to $1,150 and also $1,000 a month. Okay, so we're seeing that the monthly rental income is about the same. The annual rent is about the same. That's all great, or the same as the previous example. But what's also changed is now that the purchase price, instead of the 1.725 purchase price, the seller is actually wanting a higher price for this property. With that, looks like there's a miscalculation on this thing. So I apologize. Let me just make sure that this is right. I just noticed this right now. I'll just fix this up for everybody. There we go. That's a little bit better. So with that being said, cap rate, let's say the cap rate is actually a 6% cap rate in the market. So purchase price is 1.85. The seller is trying to sell it for 1.85. The market cap is 6%. And with that 6% market cap rate, we're buying this property below that market cap rate at 4.73%. If we were to buy it at market cap rate, or where it should be, we should actually be buying it for $1.458 million. Okay, so if I raise the rents, where I want it to go, even after I've raised it, the market cap rate is only 5.52%. So right off the bat, I know I'm overpaying, but there is really no opportunity with this building. I hope this makes sense, okay? So these are kind of three different scenarios. One's kind of more of a break-even scenario where you're generating just maybe decent cash flow. Second one is an opportunity increase valuation where I can increase income. And the third one is something that I like to call you're buying future value. And when I say that is the seller is actually making all the money and all the work and energy that you are putting into the property to raise rents, do renovations, all of those things, it's all for naught in a lot of ways. Okay. So you want to make sure that you're not buying a property where you are purchasing the property at future value. Okay. So in this scenario, that's what this is. You're even with the market cap at 6%, even after you've done all the work that you've done to it, it's only still producing 5.52%. So there's a very good chance that you'll probably lose money if you try to sell this shortly after. So be aware of these types of things, okay? This is the stuff that you want to be looking at, is looking at your numbers, okay? So with this analyzer as well, you can always do, and I'll just kind of quickly share this with you. You guys can look at this if you want to. There's lots of forecasting as well to look at how you can kind of do all sorts of different things within the property in itself, and also provide you kind of with an investment summary as well. So if anybody wants to take a look at what that is, it is on the Savvy Investor website. You guys can download it if you like, and I'll put the link onto the into the YouTube channel as well. Okay, so with that being said, let's get back to the presentation, but hopefully that was helpful for everybody to understand this. And again, I am broad brush stroking this, as you can see, but you do need to understand what the plan is. It has to start with that. And once you start to understand the plan, then you start to crunch the numbers. How do the numbers work? Do they make sense? Does that make sense? So make sure that you really pay attention to that. Okay. So the next part that you're going to look at, as you guys kind of see, we've determined rents, but there's another big important component that comes along with this that we all need to understand as well. And that is also understanding the due diligence. And that due diligence information has to come, that due diligence has to come from the seller. Okay. That has to come from the seller. And normally that is provided you in two different ways. Number one, they're actually going to give you something that is called a pro forma. And that pro forma is kind of a summary of what the investment it looks like. Okay. It's kind of a document. It is kind of more of a marketing tool, a marketing document to kind of give you a summary of the information so you can plug it into the analysis. But it is now your job to do your due diligence to ensure the seller is actually telling the truth or not. So what you're trying to do is determine, is the pro forma matching to what reality actually looks like. So it's a cross-reference to make sure your expenses and the rents are accurate. Because up to this point, you've put all the information in the analyzer based on their information. So is it true or is it not? Okay. And this is the process of due diligence. Okay. So with that being said, you're looking for any inaccuracies that will impact your cap rate, because it could very quickly change the picture of your plan very quickly. Okay. So if expenses are higher, all of a sudden that cap rate that you're hoping to buy it for is now lower. Okay. So you may be putting yourself in a position that you're overpaying for the property. Okay. So some of the things that you are needing to get is the information that I'm providing you guys here. 2 years worth of rent rolls, 2 years worth of operating statements, 2 years worth of utility bills. You want to make sure you get a copy of their insurance policy to see what their costs are. Current property tax assessment. What are they paying for taxes? Any lending, any vendor agreements as well. And a lot of this is like laundry, garbage, maybe snow removal. Get some of their contracts. And you want to see the current lease agreements, okay? And then obviously the invoices and bills for the last 2 years. Now, you're not going to get the actual data or the actual numbers until you got your offer accepted. So what you're doing is you are putting an offer in based on their pro forma, and based on their pro forma, they will give you this information, or you should be asking for this information to double check. And then again, your job is to make sure that the numbers that they are providing you is accurate, that it's a match to the pro forma. Here's a hint. They very seldomly match. So there's always an opportunity where you need to go back to the seller and negotiate the price with the seller, because if it doesn't match to what you're hoping for, you may be wanting to buy a property for a 6% cap. You've done your work, your due diligence, and now it's a 4%. You're like, Mr. Seller, I thought I was buying a property that was a 6 cap. This is a 4. To make it work, the price no longer needs to be that price. It needs to be this price, okay? No emotions, guys. This is not an emotional buy. It's all numbers. And one of the reasons why I love this part of the business. So as we kind of wrap things up, and I hope this has been very helpful for you guys for today's session. I am running a little over time. I'm hoping that you guys are feeling that you're getting some value behind this. Is you want to make sure that, multifamily to begin with, it is a great hedge against inflation. One of the reasons why that you are why it's so popular right now is because of these inflationary pressures. Exactly the things that I've talked to you about is there's this demand for rental income or rental increases and rental demand, which is becoming very, very appealing that for individuals that are in the multifamily space. Okay. Secondly, take the time to know and understand your market. And I hope that resonated well. It doesn't matter what market you're in. It could even be your own backyard. Have you taken the time to do an assessment of the market and understanding the areas? There's nuances and there's different areas that are not so good and some that are fantastic. So really identify that. Determine what market cap rates are in the area as well. So do yourself a favor, make sure you understand the cap rates. I've shared that with you guys as well. It's very, very important. It's how you determine what the average prices are for that particular area. And at the same time, know your property's acquisition strategy. What is the plan? You are buying a business. You're not just buying a business, hopefully just to buy a business. How are you going to grow the business? How are you going to adapt? How are you going to grow this part of the business? Okay. Make sure the property fits your investment goals. Again, it's always exciting to buy multifamily. Don't buy it because you're going to swollen head that, hey, I bought a 40-unit apartment building. That's all great. But does it fit your investment goals based on some of the analysis and the things that we've provided you guys in some detail there? Okay. So take the time to kind of really assess it. And again, last but not least, keep your emotions in check. This business is different, okay? It requires a lot more money and it can make a lot of big mistakes. Take the time to do your due diligence and analysis. It is all about the numbers, period, okay? So with that being said, we are going to wrap up today's session. I know we covered a lot when it comes to multifamily. And for those that are interested, take the time to educate yourself before you jump in. As we have, even regardless if it's our program, we have something called Elevate Masterclass Multifamily that's going to be starting out in a few months from now. You guys can always look on our website to learn more or through somebody else's. But as you can see, there's a lot to learn in this process. But hopefully this will help you to kind of expand and help you guys understand some of the things that you need to know before you start to jump into this space called multifamily investing. So with that being said, we're going to kind of wrap up tonight's session. I want to thank you guys all for jumping in for tonight's training session. I hope that you found that there was a lot of value to it as well. But if you guys haven't done so already, and do me a small little favor, please hit that subscribe button. Give us a thumbs up that you've liked this video. And again, hit that notification bell to keep you informed of upcoming training sessions, because we've got lots of stuff planned for Savvy Investor for this coming year. And again, for those that are watching this live or through the recording, please do not hesitate to type your comments or questions on the page. I'll make sure that I am doing my part to answer them in a more timely basis, and that you get your questions answered to help support you. Again, thanks everybody so much for joining us, and I look forward to seeing you at our next upcoming live training session. Have a good night.